Good afternoon. It's Jeffrey Christian of CPM Group. It's not quite 1 o'clock in the afternoon here on Friday, the 30th of August, last trading day of the month. I want to talk about gold and silver, and I'll also talk a little bit about platinum and palladium, their market outlook, toward the end of this video. But what I wanted to talk about right now is inflation. And there are inflation targets, and there's what you would call a normative inflation. You know, the Federal Reserve Board has an idealized target of 2.0% inflation. And you hear people and the Fed talking about this all of the time. The Fed wants to get inflation back to 2%. And that's like an idealized target. In reality, the Fed will accept inflation on a month-to-month basis or on a monthly basis or for periods of time, sometimes long periods of time, that is above 2%. It's what you would call a normative rate. You know, what happens in the real world that is acceptable both to the Fed and to the real economy. You know, what has been tolerated in terms of monthly inflation rates. And I think that it's important to understand that as we approach a period of time where the Fed is going to change its direction and it's going to lower interest rates. We're seeing very interesting mixed economy, as you would expect. There are signs of economic weakness. So the Fed has indicated very clearly that it's likely to lower interest rates in September, probably by 25 basis points. That seems to be the market consensus. That seems to be what the Fed is thinking. It seems to be what CPM Group expects to happen. There are people who think it'll be much more severe, 50 basis point cut in September, and that there will be a rapid decline in interest rates down to something close to zero, the way it was from 2009 until 2021 or so. We don't expect that. We expect modest declines in interest rates unless we get into a more severe recession than CPM Group presently is expecting. After I talk about this inflation, I'll go into our shorter-term expectations for gold, silver, platinum, and palladium prices. This is a table of normative rates. This is what's happened. And, you know, the first period that we put here was January of 1992 through March of 2021. That is after the 1991 recession, which ended in June of 1991, and up until the beginning of when inflation rates started taking off in the post-COVID global economic lockdown recovery period. You know, 2020 we saw very low inflation and very sharp declines in economic activity as the world was locked down in the face of COVID. In late 2020, early 2021, we started rolling out vaccines. People came out of hiding. Business started up again. And with business starting up again, we saw an increase in inflation, including some inflationary pressures in distribution of goods and services as the world sort of tries to reopen. So we saw a period of rising inflation from April of 2021 into, I guess, late 2021, early 2022, got up to about 9%, came back down. We're looking at this period from after the 1991 recession through the COVID recession and lockdown. And that period of time coincides and is based on the reason we picked it is that there was transitions going on in the financial world and in the global economy in the period, say, 1987 through 1991. And after the 1991 recession, we went into a different era. bottom line is that the CPI averaged 2.2% over that period of time. The Personal Consumption Expenditure Price Index, which the Fed seems to like more than the CPI, or to feel is more representative, averaged 1.8%, right? We also looked at a period June 2009 through March 2021. That is the period after the Great Recession into the beginning of the inflationary period. And you can see CPI was lower on average at 1.6, and the PCE Price Index was 1.4. And then we looked at the period 2017 through the first quarter of 2021, which basically was the Trump presidency. And you saw about a 1.9% inflation in terms of CPI and 1.6% in terms of PCE price inflation. But going back to that longer period of time, 1992 into 2021, there were 351 months in the one way we calculated CPI. And of that, 218 of the months saw inflation greater than 2%. I'll show you some charts in a minute. Some of the times it was much higher than 2%. It was 2.8%. It was over 3%. There were even a couple of spikes higher during that period of time. And the Fed didn't necessarily like those spikes higher. But overall, you had a situation where 62% of the time, that 2% idealized target was not realized. Looking at the PCE, and the numbers are a little bit different. We seem to have 2 more months in our calculations than I used with the CPI. But of the 353 months that we used in the PCE calculations, 162 of the months were over 2%. So 46% of the time, nearly half of the time, the PCE price index was more than that idealized 2%. The point I'm trying to make is you can want a 2% idealized price, but you may not expect it. And that's the way the Fed looks at the world, the real world. And that's the way you should look at the real world too. It's the way rational market participants would look at the world. Yes, we have a target of 2%, but let's be honest, let's be real. We don't always reach it. We don't always get what we want. So just going through some of these charts, this is the CPI, and this is going back to like 1947, 1948. You can see large periods of high inflation in the late 40s and early 50s, and then again in the 1970s. After the double-dip recessions of 1980 through 1982, inflation came down, and it basically has been below 5% for most of the period of time since then. A couple small spikes above that, related and correlated to recessions. And then the big spike in 2021 into 2022 and coming back down. But this is a chart that looks at the period. I took it back to 1988, just so you could see the 1991 recession, and you can see that inflation was actually higher going into that recession, spiked higher during that recession, and then came back off. And that recession ended in June of 1991. And then by the end of 1991, the beginning of 1992, you entered this long period of time where CPI was really around 2.5, 2.7. It came down at one point late in the Clinton era. Then it rose back later in the Clinton era. But you've seen large periods of time when inflation was above 2.5%, 3%, 4%, even 5%. And you can see now that the CPI has fallen back toward the high end of what that could be a normative rate, about 3.2, 2.9%, I think, with the most recent number, the little spike down at the end there. And again, the point is, don't expect the Fed to drive inflation to 2% and hold it there. That's an idealized outcome. Expect a more rational outcome and inflation pattern that is reflective of the economic realities that flavor inflation. This is because the Federal Open Market Committee leans toward or pays more attention to the PCE Price Index. This is the same period of time looking at the PCE, and you can see the PCE has come down a little bit more relative to its peak than the CPI. And again, you can see the same sort of pattern, and you can see large periods of time when the PCE price index was above that. I want to look and show you one more thing. This is the actual real inflation-adjusted personal consumption expenditures. And data came out this morning through July. You can see that personal consumption expenditures have been strong and have been continually rising since the post-COVID adjustment. And in fact, it's been slightly better than the long-term average. This is the year-over-year percentage change in the PCE price index, or actual PCE expenditures. And you can see that, we had the big dip down during the recession, the post-COVID spike higher, and it's come back down, and it's normalized pretty much about where it was in the period between the Great Recession and the COVID-inspired recession. So sort of back to normal. And that all factors into the Fed's thinking when they say, what should we do about interest rates? Talk about the markets. Gold prices have been touching new records, and they've been holding up around records. Just before I started recording this, gold, the December COMEX gold was $2,538. It was off about $21.60. We've seen across the precious metals and copper and other financial markets, we're seeing month-end book squaring and also weekend book squaring. We're going into a 3-day holiday in the United States and Canada, and I think maybe also some other countries. And there are people who have had long positions and they have done well over the last week or the last month, and they don't necessarily want to hold those long positions over the coming weekend. So there's been some book squaring selling off across several financial markets, including gold, silver, platinum, palladium, today. Gold's off about $21. We are seeing relatively healthy investment demand. There has been some pullback at the higher prices. We're seeing some interest in the part of central banks. It has cooled off quite a bit since April as the price rose. In the first half of this year, central bank net purchases were about 3.8 million ounces. There were fewer central banks buying in that period than a year ago later. There is some price sensitivity there. 3.8 for the first half would annualize to 7.6 million ounces, which would be down significantly from what we saw in terms of net purchases by central banks last year. So central banks are still there. They're still an important part of the market, but they are not driving the price higher right now. And in fact, they have pulled back significantly over the last 6 months. 6 months, 5 or 6 months, than from what we had seen in 2023 and the first 2-3 months of 2024. Our expectation continues to be that we'll see an acceleration in the gold price over the next 4 months. We've had that view for several years that the last 4 months of 2024 and into 2025 would be a period of economic, financial market, and political volatility and uncertainties, which would cause investors to step up their gold purchases. And the gold market is balanced enough that an increase in investment demand along the order of what we're thinking, a few million ounces on a net basis, would probably drive the price higher over the remainder of this year into next year. Similar situation with silver. We're now looking at the December COMEX silver contract because the September contract is now deliverable. So the next nearby active is December. And December COMEX was $29.32 just before we start recording this, which was off about 67 cents. It had been just below $30. It has been testing $30 again over the last week or so. Our expectation is that silver prices will rise over the next 4 months. So beyond the Labor Day weekend, we think that you'll see investors coming back into the silver market. It is a relatively tight market right now. So the increase that we anticipate in investment demand, we anticipate will drive silver prices higher over the course of September and into the end of the year and the beginning of 2025. We do expect the price increases in silver to be greater than the price increases in gold over the course of the fourth quarter of 2024 and the first quarter of 2025, reflecting the fact that gold prices have already risen more sharply than silver. We're not looking for $500 silver, but we do have a rational view that suggests that the price of silver is going to rise during this period of political change and uncertainty. People have been asking us what we think about platinum and palladium, and we don't focus on them too much in these videos for a variety of reasons. One is that these are more industrial metals driven by the automotive demand for platinum, palladium, rhodium, and auto catalysts, as opposed to financial assets like currencies or gold and silver. Gold and silver trade like currencies. Platinum and palladium trade like commodities. And we have a we don't have great expectations for sharply higher prices for platinum or palladium, given the fundamentals on the fabrication demand side and investment demand to a lesser extent. The one positive that you can say about platinum and palladium is that there are serious supply constraints. But since we don't necessarily see platinum and palladium as attractive to investors at this point, we tend to not focus on them much in these videos. That said, we look at platinum, we look at prices around $933 today. That's right in the middle of the range of price that we expect over the next 3 months. So we're looking, spikes down to 860 are definitely possible. Spikes up to 1,000 or a little over 1,000 are definitely possible. We don't necessarily see the price spiking sharply beyond that range for platinum. And similarly with palladium, I think we're probably a little bit more bearish about palladium, and this chart kind of highlights why. We've seen palladium prices coming down very sharply. They'd obviously risen very sharply from 2016 to 2021, 2022. And since the Russians invaded Ukraine at the start of 2022, we've seen the palladium price come down. And that reflects changing fundamentals, automotive demand, less use of palladium in auto catalysts for a variety of reasons, which I think we have talked about recently. We definitely write about it in our reports. So we're less bullish about palladium. Palladium right now is about $960.50. So it's at a small premium over platinum right now. The two have been sort of trading parity over the last few months or so. Our expectation for the price of palladium is very similar to the price range over the next 3 months for platinum, with a little bit more of a downside bias probably for palladium than for platinum. That's all I have for now. Have a good weekend. Take care of yourself. Take care of those around you. Be good to others. Try to do something good for the world. If you are in one of those countries that is taking off the first Monday of September, enjoy it. Do something interesting and productive. If you want to, you can come to our website. You may download and buy our books, our Gold Yearbook, our Silver Yearbook, or our Platinum Group Metals Yearbook. There are a lot of free reads and videos that you can peruse at our website. You can learn more about other services that we're offering. And you can write to us at info@cpmgroup.com and say, let's talk about the ways that CPM Group can be of assistance to me in managing my exposure to precious metals and commodity prices. Again, take care of yourself and those around you, and have a good weekend.